Spotify is a stock in which has seen massive growth in the last couple of months, with it breaking out in November and since then being up 244%. We are now seeing a bit of selling pressure in this stock. However, despite this, we are still on a long position on the MACD indicator and on this other indicator here, which takes into account other indicators. It is still in a long position. How long can we expect this to stay long? However, let's try and find out. So Spotify has been getting a lot of traction on X as of recently, as many people are saying that they are buying into Spotify. However, despite this, of course, we have seen this stock price decrease 21% in the last couple of weeks, but that could just be because the broad market has declined. What is the intrinsic value saying for this stock? Well, in my opinion, this stock actually looks to be overvalued for its current growth. However, that doesn't yet mean to say that it isn't still a solid buy. Spotify currently has a price to earnings ratio of 90 and an earnings per share of only 5.9 at 532. Spotify have actually missed their estimates quite significantly in the last couple of quarters, with them being down minus 12% and minus 14% on the surprise rate. But despite this, analysts are actually still putting Spotify in at a buy, with 17 putting it at a strong buy, 6 at a buy, 11 at a hold, and only 3 at a sell and strong sell. So what can we see when we actually do a technical analysis of their financials and conduct an intrinsic valuation for this company? Well, starting off strong here, we have their liquidity ratio, and we can see that on a liquidity basis, they are roughly around the 3% mark, which means for every dollar of debt in which they owe, they have $3.7 of liquid cash to pay this back in, which is really good. And if we look at the retention rate here, we can see that their retention is below 10%, which isn't actually what you would like to see for a company like Spotify, as of course they are a subscription online service. You would expect this to be a lot higher. That does raise questions as to what exactly they are spending their money on. And when we look at their free cash flow, we can see that this is relatively increasing quarter on quarter, and the difference between their operating and free cash flow is decreasing, which could be seen as good or bad, and their free cash flow as a whole is of course increasing. So looking on a 365-day exponential chart here, we can see that of course we have seen this massive increase in Spotify. However, we are now below this trend line. That could signal that we are going to see a bit more selling pressure, but it could also signal that we might catch up with this trend line. On a volume basis, we actually haven't seen this maintain the same speed as the price, which could suggest that this massive hike in recent price is unsustainable. And on a 91-day basis, it is the same story. However, here we are actually seeing this volume catching up with the price. So it could be that we are now in a denial stage with Spotify, especially when you look on X. There is a lot of people basically saying how great Spotify is, which is true. It is a very good company and a really good stock, but in my opinion, it does now look overvalued, and that is what we're going to get onto in a minute. But what are the quick figures for this company? Well, of course, they have the PE ratio of 93, a 52-week high of 652, and a low of 249, this being a difference of 403. They have a market cap of 108 billion, and they have a beta of 1.78. So when we look on the intrinsic value for this company, what do we see? Well, this isn't looking particularly good for Spotify, with an earnings per share currently set at 5.91 and a growth rate set at 28.8. That is including the surprise rate, which of course brought them down a bit. We get an intrinsic value set of $358 on the bullish. And on a bearish formula, we can see that the intrinsic value is only set at 194, with the current price being set at 531, with a margin of safety of 25%. This gives you an acceptable buy price at 268 on the left bullish and 145 on the right bearish. If we go in between the two of these, we get a mean of 276 on the intrinsic value for this year's growth and an acceptable buy price of 207. So intrinsically for this year's growth, Spotify definitely looks to be massively overvalued. But of course, this is providing that the analysts get their estimates right with the growth for this current year, and looking at previous estimates, they could have actually overshot it. So I don't think it's fair to say that this is inaccurate. And now looking on Peter Lynch's valuation, we get a score of 0.3, which suggests this stock is massively overvalued. So I can't really justify bumping this up to a fairly valued at this point, but it is closer to a fairly valued than overvalued in my opinion at the moment. So on a discounted free cash flow analysis, what are the figures that we pull out? Well, on a 9-year basis, we can expect this stock to be around $1,000, which seems fair, but on a 3-year growth, we're only projected in at $344, which is obviously well below where we currently are, and that is assuming that that is the 3-year growth. If we look at this year's growth, we see that this stock should only be priced in at $114. So this suggests that this stock definitely looks overvalued on a free cash flow basis, and on intrinsic growth, this stock also looks massively overvalued currently. And of course, with the PE ratio being 90, it's fair to say this stock does definitely look overvalued. Does that mean to say we're not going to see more growth in this stock? Well, potentially yes, it should basically mean that, but that doesn't always mean this isn't always the case. Such with Palantir, that is massively overvalued, but that continued to grow for months and months. We are obviously now seeing a massive decline in the price of Spotify, but how long that will last for, who actually knows? I don't want to put a number on it, but I think it could last for a couple of more weeks along with this market correction. Stocks with high PEs like this tend to take the brunt of the fall more so than other stocks. But I think long term, if you are getting into Spotify, then it will be a perfectly sound investment. I think it is a great company, and they do great things, and they do have a monopoly on the audio market. There's only competition like Apple Music, YouTube Music, Amazon Music, which nobody uses. So realistically, in my opinion, it's just YouTube Music and Spotify. There isn't really any other competitors. So therefore, I think it's fair to say they are an amazing company to invest in, but they are not something in which I want to invest in personally. And so therefore, at the bottom here, we can see Spotify, and I'm putting this at a hold currently. I do think this kind of warrants a sell. I think if you are holding this stock, it could be a good time to sell for short-term gain. Maybe it's something to trim. I don't think it's something you should completely sell out of, but this would be a good time to be taking profits. But I do think long-term growth for this company will be really good. So therefore, if you are in it for the long run, I would advise staying in. But of course, I'm not a financial advisor. This is not financial advice. So I'm going to end that video here. I hope this has been useful and you have taken something away from this. If you have, please do hit the like and subscribe button. It would be greatly appreciated. Follow my X in the link in the description. Again, I hope you have enjoyed, and I'll see you for the next video.